So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish, or a single high that is inside of the previous day's range. Now, I know there's no chart here, but I want you to think about it conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up, ICT? Wait. Look, you just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble, because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say? The best shorts will occur in the lower 50% of the previous day's range. Where do they form? Above old highs, inside of that range. Where you look for it, just like the algorithm will look for it, is going to look into 15-minute high or highs, or 5-minute high or highs inside that range. So if you're in a 5 or 15-minute chart, it can't hide from you. It's right there. And you're going to anticipate the market running up there. And when it does, you paper trade it. You tape read it. You do not live trade it. You have to condition yourself to do this. And it takes weeks and months to do it. Not, a couple weeks I've been doing it. I know what I'm doing. No, you don't. No, you don't. You do not. It takes time to desensitize yourself to the fear that London can create, because it's very, very volatile. It can run up there and rip right lower, and really, if you know what you're doing, you can miss it or second guess it and totally do harm to yourself. So in London, you're looking for turtle soup scenarios, okay? And continuation on the basis of the higher time frame order flow. High a day, low a day is what's formed in the London session. Most of the time. Not all the time, most of the time. In New York session, this is going to be for Forex traders, the New York Open Kill Zone, which is 7 o'clock to 10 o'clock, New York local time. If you are an index trader, you can use that same time window as well. You use that time window before the opening at 9:30, like between, like, say, 7 o'clock in the morning New York local time to 8:30. You can trade that time window when there is a really big high impact news driver for that day. For instance, like FOMC. Okay, say FOMC, or let's say, we'll stick to that. FOMC is probably like the best case explanation for why you would want to trade before the 8:30 hour, because generally what will happen is you'll get these really nice little price runs that are, and I've executed and showed you this throughout the year, and last year I was doing it too. And usually it's the time or examples where you see people saying, "But didn't you say we have to wait for this and we have to wait for 10 o'clock?" Folks, I'm giving you different models. That way you are allowing yourself to pick up on what you want to do. I can trade all of them, but I can't make you be able to trade all of them. I mean, over time you can if you put the time into it, but you have to find your own special time of the day in the asset class that you trade. And that's what I'm covering here. I'm helping you refine your level of focus so you can pinpoint what your model is going to operate in terms of time. So that way you're not doing more than that's required. You're not diluting your attention, and you're also controlling fear of missing out. Because if you're operating in a business model or trading model that allows you to only operate in this 2 or 3 window time period of every individual day, you turn the charts off and you walk away and you exercise discipline. Over time, you won't care what the market has done over here or this time of day, or who made this, who made that. You're trying to get better at this. You can't improve by worrying about how much other people, me or anyone else, is making or losing, or how often we get it right or wrong. You can't do anything to make yourself better by doing that. So why are you worrying about it? If you're pocket watching me or anyone else, or if you're entertaining other people that do that, you are wasting your time. You're wasting time to groom yourself into the analyst that's necessary for that profitable trader to work with, because the trader's not going to be doing anything except for what the analyst says is good to go.